Hey there, and welcome to The Explainer. Today, we are tackling something that's literally the lifeblood of any business. Getting paid, right? I mean, if you want to get your money faster, keep that cash flow healthy, and ensure your books are just squeaky clean, well, you are definitely in the right place. We're going to break down exactly how a business moves from, finishing the hard work to actually seeing that money safely in the bank, and how to record it all without making a total mess of your accounting. So, let's just dive right in. Okay, so picture this. You've got a graphic designer. Let's call her Maya. Maya just wrapped up this massive, totally exhausting branding project for a new client. The client is absolutely thrilled. The files are all delivered. Those long nights of work, finally over. But Maya checks her bank account and nothing. She hasn't seen a single dime hit her balance yet. Why is that? Well, because doing the work and actually getting paid for the work are two entirely different things in the world of business accounting. Just because the job is done doesn't mean the financial loop is closed. And this, right here, brilliantly illustrates the mental map we're going to use for this entire explainer. Think of this as the ultimate solution to your cash flow woes. A super simple, really practical, 5-step flow. Step 1, do the work. Step 2, send the invoice. Step 3, track what's owed. Step 4, receive the payment. And finally, Step 5, properly record that payment. Look, if you skip a step or kind of jumble them up, you are going to run into some major bookkeeping headaches. But by following this exact sequence, you'll make sure your books actually match reality. All right, let's get into it. Steps 1 and 2, work and the request. So let's start right at the beginning. It is absolutely crucial to separate the act of finishing your job from formally asking for the money. See, Maya finished the logo, but she hasn't officially asked for her compensation yet. An invoice inside QuickBooks is essentially just a formal request for payment that you send to a customer after you've provided the products or services. Honestly, it's kind of like handing someone a menu at a restaurant, right? You're showing them what they owe, but you haven't eaten yet. The payment is the actual cash, the meal itself. Just creating an invoice does not mean you have the money. It's literally just the formal request. So how do we actually make that formal request? Well, the basic process inside QuickBooks is a breeze. First, you just select your customer. Then you enter the services you provided, like Maya's branding package. Next up, you add those all-important invoice and due dates. Give your rates a quick review, add any applicable sales tax, and simply hit save and send. Boom! You've officially asked to be paid. Moving right along to step 3, the waiting game. Okay, so you've hit send. Now what? Well, that invoice remains open until the customer pays it. And during this waiting period, it sits in a very specific bookkeeping category called Accounts Receivable. Now, let's strip away the accounting jargon for a second. Accounts Receivable? It simply represents money your customers owe you for work you've already completed. That's it. Tracking this open balance is essentially checking the pulse of your business's cash flow. If your accounts receivable is just skyrocketing, it means you're doing a whole lot of work but not actually collecting the cash. And hey, you need that money to pay your own bills. All right, now for the really fun part. Steps 4 and 5, the money move. The client loves the work, and they are finally ready to pay up. But how do we handle that cash movement digitally? This is exactly where we need to distinguish between QuickBooks Invoicing and QuickBooks Payments. See, QuickBooks Payments is actually a separate merchant processing service that can connect right with your software. It allows eligible businesses to accept electronic payments directly from those invoices we just created. Depending on your specific agreement, your customers might be able to pay you using credit cards, debit cards, bank transfers, or ACH, literally right from an online payment button. Let's look at the chronological path your money takes here. Minute 1, your customer gets the invoice and clicks pay. Hour 1, behind the scenes, the payment processor does its job, taking a tiny cut for providing the service. Day 1 or 2, the remaining net amount actually lands in your checking accounts. Honestly, understanding this timeline is absolutely vital to keeping your books accurate. Which brings us to our next point, the invisible middleman, merchant fees. Have you ever noticed a really confusing discrepancy between what your customer actually paid you and what eventually lands in your bank account? It's the worst, right? Let's say Maya sent an invoice for $500. Her client pays the full $500. But when Maya checks her bank account, there is only a deposit of $485. So where on earth did that $15 go? Well, those are the merchant fees. They're the charges assessed for processing that electronic payment. The exact amount depends on the payment method, the type of card used, and your specific pricing agreement. Basically, the processor took its cut, leaving Maya with a net deposit. So the really crucial point here is how you handle this in your bookkeeping. QuickBooks has to reflect the whole story: the full amount paid by the customer, the merchant processing fee that got taken out, and the actual net amount deposited into the bank. Merchant fees generally need to be recorded completely separately from your sales income. Why? Because as a business owner, you need to accurately see both your gross revenue, what you actually earned, and your payment processing costs, what it cost you to collect that money.
Now we have to talk about the big trap: bookkeeping nightmares. Because here is where things can go horribly wrong if you rush through these final steps. Imagine running a report at the end of the month and having this total panic moment. Wait, why did my income just double? I definitely didn't make that much money. Yeah, this happens when a very specific error is made regarding the bank feed.
Let's break down exactly how this duplication happens. First, the customer pays the invoice. Great. That payment is recorded in QuickBooks against the invoice. But a couple of days later, the actual cash deposit hits the bank feed. If a user mistakenly clicks on that bank deposit and adds it as brand new income instead of matching it to the already paid invoice, well, the system thinks you got paid twice. The invoice recorded the income, and now the bank feed recorded it again. The results? Your income is artificially doubled, and your tax bill is going to look absolutely terrifying. And unfortunately, that is not the only mistake to watch out for. There are a few others that can just totally wreck your cash flow visibility. For example, receiving a payment without actively applying it to the correct invoice leaves that invoice looking unpaid. It literally makes it seem like the customer still owes you money. Another huge mistake: deleting an invoice after the customer has paid it. No way, never do that. You need that record. Also, recording only the net deposit while completely ignoring the merchant fees, that throws off your gross revenue. And finally, rushing and matching a deposit to the wrong customer payment will make an absolute mess of your accounts receivable. To avoid all of this, you just need to remember this golden rule. Always apply the payment to the correct invoice and then simply match the deposit when it pops up in the bank feed. Do not add it as new income. The 5-step flow we started with, it only works seamlessly if that final payment is explicitly linked back to the original request. The automated features in QuickBooks can definitely help connect deposits with bank fee transactions, but hey, automation doesn't eliminate the need for you to review it carefully. Let's think back to Maya's $500 project. By doing the work, sending the invoice, tracking what's owed, receiving the payment, and accurately recording the gross amount minus the fee, she knows exactly where her business stands. So I'm going to leave you with this question. If you were to open your books right now, is your invoicing process actually helping your cash flow, or is it secretly duplicating your income and inflating your unpaid invoices? It might just be time to check your setup and make sure you are mastering the 5 steps to getting paid.